Hi, my name is Jeffrey Bangeter, and my NMLS number, that's the Nationwide Mortgage Licensing System number, is 18361. I certainly am a mortgage broker, or a mortgage loan originator, but I am also an enrolled agent. And so, as I talk to you about the reverse mortgage, I do have an extensive background in tax preparation as well. I have several other licenses, including real estate, insurance, and some others. So as we talk about this, I want to let you know that I'm available to consult with you as to whether or not this would be a good program for any of your clients. Be happy to give you a quote, absolutely free, no obligation, let you know what kind of numbers are available. This is my website, reversemortgage4u.com. I'm going to go ahead and get that out of the way, and I'm going to jump right into the software and show you some examples of the reverse mortgage. The limits have been increased, allowing older folks to get more money. So I used a date of birth here on our sample client of 1/1 of 1944 to make this client 70 years old. And I made his wife 70 years old as well. So there's Mrs. Client, also going to be 70 years old. And what I did is I ran the property value at $650,000. I did that purposely because the maximum home value for a reverse mortgage is $625,500. And so I want you to be able to see kind of how that affects it. I'm going to come back and show you a reverse mortgage with debt on the property, which is most often what we see. This one will start off with no liens on the property, so you can see how that would affect the borrower. I'm going to jump right to this comparison page because this is really where the programs kind of differentiate. And so the first one up here, the highlighted one, is the HECM monthly. That's the home equity conversion mortgage. This is a monthly adjustable rate. This is based on the 1 month LIBOR, which is the London Interbank Offered Rate. Then we have a fixed rate. This is a standard fixed rate product. 5.06 is the rate that's available. And then the HECM annual, this is a 1 year adjustable LIBOR rate. And so you'll get to see kind of the differences between the three programs. So first, as we go down the monthly LIBOR, we've got a margin of 2.375 with an initial rate of 2.531. So that shows you how low the LIBOR rate is, and you can see the annual at 2.926. So it is a bit higher, obviously, for the 1 year. The expected rate, they use the 10-year continuously maturing treasury to determine this. And this expected rate is actually what they use to determine how much money the borrower can get. So even though it's kind of a misnomer calling it an expected rate, we don't expect the rate to be that at all. The rate is going to fluctuate. And so this is kind of an odd name for it, but it's what they use to determine how much the borrower can get. And you can see on the fixed rate, the 5.06 is the same as what it is. And then again, you've got the expected rate for the 1 year LIBOR hitting the same at the 4.935 because they're using the same 10-year continuously maturing treasuries. MIP is mortgage insurance premium. This is a fee that FHA charges. They actually charge an upfront mortgage insurance premium and a yearly mortgage insurance premium of 1.25% of the outstanding balance of the loan. So that's going to be a fee that's going to the government. That's not something that the lender charges, something that gets paid to the FHA. The cap on the interest rates on the 1 month LIBOR, it's a 10-point spread. So you can see we're going from 2.531 to 12.531, whereas you only have a 5-point spread on the 1 year. So you're going up to 7.926. It kind of depends on what your borrower's need is. If they're going to leave a lot of money in the line of credit, then the line of credit growth is going to be predicated on the interest that we're charging too. So in the future, as interest rates go up, you could actually want it to go up more so that your borrower would have more money available. Now, again, the interest rate on the fixed is fixed, so you don't have to worry about it changing. And then again, the initial line of credit growth rate. Now, I always like to clarify this is not, your client is not earning any interest because we do not have their money. It's still equity in their home. So if they've let it set in the line of credit, it's just money still available for us to lend them on the value of their home. And so this is going up at an initial rate of 3.781 and 4.176. The fixed rate does not offer a line of credit. You must take all the money available at the close of escrow. There is no money left in the account for the borrower for future draw. Home value, $650 across the board. Lending limit, $625.5 across the board there too. Max claim amount, $625.5. So I did that $650 home value so that you can see, even if it was $1 million, it would still get limited out at $625,500. So the principal limit is the first calculation based on the client's age and that expected interest rate. And you can see that it shoots across the board $364,666.50 for any of the products. There is no service set aside or monthly servicing fee on any of these. Then the adjusted principal limit is coming up with, again, how much is available. It's the same because there is no service set aside here. Then you have the initial mortgage insurance premium. It's relatively low because we have most of the money just in a line of credit. We haven't requested the full draw, if you will. And you'll see this change when I do the next example. Then the origination fee, this is $6,000. That's the maximum it can be regardless of home value, and is much smaller on smaller home values. So if you had a $300,000 home, you're going to see maybe a cap out about $4,000. So again, and this is something that is negotiable, and we could certainly talk about that with your with your borrower if you have somebody looking. Other costs, these are all of the things that you would normally see in a real estate mortgage transaction. You're going to have the closing costs, the appraisal fees, the credit reports, flood certificates, all of that stuff. So that's the same across the board too. Then you have this remaining principal limit, $352,000, again shooting across the board. There's no set-asides. We're not paying off a mortgage. There's no tax withholding or anything. They're going to have to pay their own tax. So then you have this available principal limit, which is the same number. And here's where you see the real difference start to come in on the product, because the funds available at closing are $207,000 across the board. You can take a monthly 10-year lifetime, not 10 years, but 10-year payment. In this example, $2,173. You see it's not available on the fixed product. You must take the $207,000. So this is a choice. You can take $207,000 or you can take $2,173 per month. Same with the annual adjustable rate. Now, if you do decide to take the cash request, $207,000, you can see it's the same with these two. This one I left all the money in the line of credit. All right. Now, if I take the $207,000 in either of these products, right, so in the adjustable rate, I have more money available after the first year, another $145,000. But if I did the fixed rate, I don't have that available. And this is FHA trying to discourage people from taking all of the money. So in an adjustable rate, they restrict how much you can get the first year, and in a fixed rate, because there is no line of credit, you only get the $207,000 and you forego that $145,000 that's left if you chose the adjustable rate. So they are definitely controlling the actions of the borrowers, if you will. So now you can see we've got $145,000 left here, but we have the entire $352,000 available if you didn't take any draw. Because you don't have to. You could just open up a line of credit, start getting monthly payments, or just have the line of credit grow at the line of credit growth rate and have that money just available if you needed it in the future. Total mandatory obligations. This is all the closing costs, loan origination fee, the FHA mortgage insurance premium. All of that stuff is lumped together, and it shows you the percentage of the principal limit, the initial disbursement in these cases, and then the percentage of the principal limit. And so what the government did is they capped out how much a borrower could take at 60% of that principal limit. And so that's why you see on that fixed rate they get the $207,000 and then nothing else, or here they get the $207,000 and then they have access to more after the first year. They want to make sure people get that far. So all right, let me go on and just change this just a little bit to show you an example. So now I'm going to add a significant mortgage of $339,000. And let's go back to that comparison. So all of the top is the same, so there's no reason to look there, but the principal limit, the 340, is the same number. Liens and mortgages now, $339,000 across the board. That leaves another $1,461 that is available to the client. We just give that to them at the close of escrow. Here you see it as the cash request. In this last one, I left it in the line of credit. Most, again, you can do that. Most people wouldn't do that with that small of an amount. But so you can see, instead of getting capped out of that $207,000, the fixed rate, we were able to get the entire $339,000. Now take a look at the mortgage insurance premium. So this is the initial mortgage insurance premium that FHA charges. It jumped up dramatically, and so that was another way that FHA is trying to motivate people to not take all of the money out. So if you do 60% or less, they have this relatively small initial mortgage insurance premium. If you go above 60%, and the only way you can go above 60% is if your total mandatory obligations, which would be your mortgage and all of the fees, if they are above 60%, then you can go above 60%. And you can see they're showing the percentage principal limit, 99.6%. The initial disbursement, $364,666, which is all of the money. That's because we cashed out that other $1,461 at the end. And so each product has its own place for the client. If they have a big debt on the property, the fixed rate might be the right way to go because you can lock in that 5% interest. If they don't have a lot of debt on the property and they want to grow the money as much as possible, the monthly LIBOR will be better. As interest rates go up, you'll see a bigger line of credit growth. But if they want to restrict how much the interest rate can go up, then the 1-year LIBOR would be the best choice.